Let's imagine two men, same city, same year, same $50,000 saved. One of them buys a rental property. The other puts everything into gold. And 20 years later, when you run the real numbers, not the numbers they imagined on day one, but the actual costs, the actual returns, the actual outcome. One of them has over $400,000. The other has less than $200,000. Same starting line. A gap of nearly $250,000. And the reason for that gap is not luck. It is not timing. It is something far more specific and far more useful. And that's exactly what this video is going to show you. Paul Martinez was 31 years old in 2004 when he put his $50,000 down as a 20% down payment on a $250,000 rental property. 3 bedrooms, decent neighborhood, nothing exceptional. He took out a 30-year fixed mortgage at 7% interest. His monthly payment came to $1,330. His tenant agreed to pay $1,800 a month. On paper, that looked like $470 a month in clear profit. Paul thought he had figured something out that most people miss. Nick Webb was also 31. He took the same $50,000 and bought gold. Physical bars stored in a certified vault. No mortgage, no tenants, no liability of any kind. He had read everything he could find about monetary history, about what happens to paper currencies over long periods of time, about the one asset that every civilization in recorded history has recognized as valuable. Nick also thought he had figured something out that most people miss. Here is what neither of them fully understood yet. They were both right about their asset, and both of them were dangerously wrong about how much they were relying on it. Let's start with what actually happened to Paul in year one, because this is the part of the real estate story that almost never gets told, honestly. Paul's first tenant moved out after 8 months. The kitchen needed $3,000 in repairs. It then took Paul 6 weeks to find a replacement. 6 weeks of zero rent while the mortgage kept coming. During that same stretch, the HVAC unit failed. $1,800 repair. When Paul sat down in December of 2004 and added up his actual numbers for the year, mortgage, property taxes, insurance, the repairs, the vacancy, that $470 monthly profit had become a monthly loss, not by a little, by enough that Paul had quietly stopped mentioning the rental property at family gatherings. This is the number that almost no real estate presentation shows you before you buy. The actual monthly cost structure of a rental property looks like this. Mortgage, $1,330. Property taxes, roughly $250 a month. Insurance, about $100. Maintenance and repairs. The standard industry estimate is 1 to 2% of the property's value per year, which on a $250,000 home means $2,500 to $5,000 a year, averaged out to $200 to $400 a month. Vacancy. The national average is roughly 1 month of zero rent per year. And if you hire a property manager so you're not the one fielding midnight calls, that's another 8 to 10% of collected rent, around $150 to $180 a month. Add all of that together, and Paul's real monthly costs fall somewhere between $1,880 and $2,260 against $1,800 coming in. In the early years, Paul was either breaking even or losing money before a single surprise expense hit. And in real estate, surprise expenses always hit. A roof replacement runs $8,000 to $15,000. An HVAC system is $5,000 to $10,000. A tenant who stops paying rent and requires legal action to remove can cost months of lost income and thousands in legal fees on top of that. Nick, in that same first year, watched gold do almost nothing. A small gain, barely above inflation. He checked his account, shrugged, and went back to his life. No phone calls, no repair bills, no decisions required. He was beginning to feel very calm about the whole arrangement. And then 2008 happened. Banks that had existed for over a century failed inside of a single weekend. The stock market lost 37% of its value in 1 year. Home prices across America fell 30, 40, and in some cities like Las Vegas and Miami, 50% or more. Paul's property dropped in value. His paper equity shrank. And the phone calls did not stop. A leaking pipe in February, a tenant dispute in spring, a city inspection that triggered $2,000 in electrical work he hadn't planned for. Nick watched gold surge 25% that year. While retirement accounts were being cut in half and homeowners were walking away from properties they'd held for a decade, Nick's gold climbed. He didn't do a single thing. He just owned the one asset that tends to rise when everything else falls apart. For a moment, Nick looked like the most prepared person he knew. But here is the financial fact that most gold investors have never fully confronted. From 1980 to 2000, a full 20 years, gold didn't just underperform other assets. It lost value in real terms. If you had bought gold at its previous peak in January of 1980, you would not have broken even until 2008. 28 years of holding an asset that produced no income and no growth while the rest of the economy moved forward. Nick didn't buy at the 1980 peak, but he did buy near an all-time high. And the pattern of what tends to follow those entry points is documented, consistent, and uncomfortable. From 2012 to 2019, gold went essentially sideways. 7 years. Nick's position, which had felt like vindication in 2009, was quietly being eroded by inflation. The number in his account wasn't falling, but what that number could actually buy in the real world was shrinking every year. And here is the core problem with an asset that produces no income, no rent, no dividends, no interest of any kind. The only way it makes you money is if the price goes up. When the price stays flat, you earn nothing. When inflation runs faster than the price increase, you are falling behind while standing still. There is also a tax issue that most gold investors discover too late. The IRS classifies gold as a collectible, the same legal category as stamps, coins, and fine art. When Nick eventually sells, the maximum federal capital gains rate on collectibles is 28%. Compare that to 15 to 20% on most long-term stock or real estate gains. Even when gold does deliver strong returns, the government takes a larger share of those returns than it would from almost any other investment vehicle. Meanwhile, something quiet and powerful was happening inside Paul's investment. Rent does not stay flat. It tends to rise with inflation and with local demand, roughly 3 to 4% per year over long periods. By 2010, Paul's tenant was paying close to $2,000 a month. By 2013, it was $2,200. By 2016, it was approaching $2,400. But Paul's mortgage payment had not moved by a single dollar. Still $1,330. The same number it had been in 2004. Fixed for 30 years. Immovable. That gap between a rising rent and a fixed mortgage is one of the most powerful and least talked about financial dynamics in real estate. The wider it gets, the more Paul's monthly cash flow improves automatically, without any decision required. And more of each mortgage payment was now going toward actual principal rather than interest, which meant Paul's ownership stake in the property, his equity, was building faster with every passing year. The property itself was appreciating at a conservative 3.5% annually. The $250,000 home Paul bought in 2004 was worth roughly $295,000 by 2009, $345,000 by 2014, and approaching $430,000 by 2019. The equity Paul had acquired was compounding the same way moss grows on stone, slowly, invisibly, and then you look and you cannot believe how much has accumulated. Now let's run the full 20-year numbers side by side, because this is the comparison the entire story has been building toward. Paul's property, appreciating at 3.5% per year for 2 decades, is now worth approximately $490,000. His remaining mortgage balance after 20 years of payments is about $128,000. That means Paul's equity, his actual ownership stake, is roughly $362,000 in a property he purchased with $50,000 down. On top of that, his cumulative net rental income over 20 years, after every repair, every vacancy period, every unexpected cost, falls somewhere between $60,000 and $100,000. Total combined position, north of $420,000. Nick, using gold's long-term average return of roughly 8% annually, which is actually generous given his near-peak entry point, has watched his $50,000 grow to approximately $233,000. After the 28% collectible tax on his gains, his after-tax position is closer to $182,000. Paul. over 420,000. Nick, around 182,000 after taxes. Same starting line, same $50,000. The reason the gap is this wide comes down to one concept: leverage. Leverage simply means using borrowed money alongside your own to control a larger asset. Paul used $50,000 to control a $250,000 property. That is 5-to-1 leverage. Every dollar of appreciation on that property worked 5 times harder than it would have worked in a direct investment. Nick used $50,000 to control $50,000 in gold. No leverage. Dollar for dollar. When the underlying asset grows, leverage is a multiplier. Over 20 years, that multiplier is the primary engine of the gap between them. But before you conclude that Paul was right and Nick was wrong, you need the part of this story that the numbers do not show. Paul spent 20 years managing that property. He dealt with a mold issue in 2011 that cost $8,000 in 2 months of legal correspondence. A tenant stopped paying rent in 2017 and took 4 months and $3,000 in legal fees to remove, while the mortgage continued the entire time. He replaced the roof in 2015 for $12,000. He replaced the water heater twice. He answered calls on Christmas morning. He lost weekends to maintenance. He couldn't justify paying someone else to handle. When you divide Paul's actual net profit by the total hours he invested in managing the property over 20 years, some years he was earning less than a decent hourly wage. Real estate did not give Paul passive income. It gave him a second business, and he ran it on top of everything else in his life. Nick, over those same 20 years, made approximately 4 phone calls related to his gold investment. He filed a different line on his annual tax return. That was the full extent of his involvement. Real estate is illiquid. That means you cannot quickly convert it to cash when life requires it. If Paul needed $10,000 in an emergency, he could not sell a bathroom. He either borrowed against the property or sold it entirely, a process that takes months and costs 5 to 6% in agent commissions and closing fees on top of any capital gains taxes. On a $490,000 property, that exit cost alone is $25,000 to $35,000 before Paul sees a dollar. Concentration risk is also real. Paul's entire investment is one property, in one neighborhood, in one city. If the local economy deteriorates or a major employer leaves or a flood zone is redrawn, his net worth takes the full impact directly. Gold has none of those vulnerabilities. You can sell a gold ETF, an exchange-traded fund that tracks the gold price, in 30 seconds on your phone. There are no tenants, no maintenance costs, no property taxes, no transaction friction. And gold holds a unique position that real estate does not. It is universally recognized, completely portable, and it does not depend on any government, any bank, or any legal system to maintain its value. In countries or periods of genuine instability, currency collapse, banking failures, political upheaval, gold is not just an investment. For many people, it has been the difference between preserving wealth and losing everything. So here is what you should actually take away from Paul and Nick's story. Real estate is a genuine wealth-building machine when it is used correctly. In the right market, with realistic cost assumptions, a long time horizon, and a clear-eyed understanding of what active management actually requires. The combination of leverage, rental income, equity buildup, and tax advantages creates a compounding effect that gold simply cannot replicate over long periods. But it demands something from you in return: time, patience, local knowledge, and the ability to absorb unexpected expenses without panic. For someone with a long runway, access to financing, and the capacity to manage or oversee a property, real estate has historically been one of the most reliable paths to building meaningful wealth. Gold is not a growth engine. Over the full sweep of history, it barely stays ahead of inflation in normal times, but it is something arguably more valuable in the right circumstances. It is crisis protection. It performs exactly when everything else is falling apart, and it requires nothing from you in the interim. A measured allocation to gold, somewhere between 5 and 15% of a total portfolio, is not a bet against growth. It is insurance against the scenarios where growth disappears and preservation becomes the only goal that matters. The real mistake that Paul and Nick both made was the same mistake, expressed in opposite directions. Paul went entirely into an illiquid, management-intensive asset that demanded 20 years of his time and tied up all his capital in one place. Nick went entirely into an asset that produces nothing and compounds only when fear is high. Neither of them was wrong about what they chose. Both of them were wrong about treating their choice as a complete strategy rather than one component of one. If you are someone in your 20s or 30s with stable income, access to financing, and the willingness to treat property ownership like the active responsibility it actually is, real estate belongs in your wealth building plan. If you are someone closer to or in retirement who needs liquidity, simplicity, and protection against economic disruption, a meaningful gold allocation makes clear sense. And if you are someone who resonates with real estate's compounding power but has no interest in managing tenants, real estate investment trusts, known as REITs, let you invest in professionally managed real estate portfolios through the stock market with complete liquidity, regular dividend income, and no operational demands on your time. Paul built more. Nick slept better. And both of them, if you sit down with them honestly, will tell you they wish they had owned a little of what the other one had. Because the real answer to which is better was never gold. And it was never real estate. It was the understanding that these two assets exist to do completely different things, and that the most expensive mistake you can make with either of them is to treat it as a substitute for thinking clearly about the other. The money you have right now is not a bet you are required to make on one side of this question. It is a question in itself, and the quality of your answer depends entirely on how clearly you understand what you are actually buying.